How banks create money out of thin air. The money in your bank account isn't really there. That's not a metaphor, and it's not a conspiracy theory. If everyone tried to withdraw their cash tomorrow, the entire system would collapse within hours. Why? Because the money simply doesn't exist. This isn't a flaw. It's the very design of our global financial system. A centuries-old illusion so deeply rooted that we've accepted it as normal. It's called fractional reserve banking, and it's the silent engine powering global debt, inflation, and the illusion of prosperity. Once you understand how it works, you'll realize money is built on promises that can never truly be kept. Long before credit cards, before digital wallets, in medieval Europe, gold and silver were real money. The wealthy kept coins locked away, but carrying treasure was dangerous. So they began storing it with goldsmiths, who issued paper receipts, simple notes promising that whoever held them could claim the gold later. Those receipts soon became easier to trade than the gold itself, and that's where the magic, or the deception, began. The goldsmiths noticed something. Almost nobody came to collect their gold at the same time. Most of it just sat there untouched. So they started issuing more receipts than the gold they actually held. If they had 1,000 coins, they could lend 2,000 worth of receipts, charging interest on gold that didn't even exist. As long as no one asked for all their gold back at once, nobody noticed. And just like that, money was created from nothing. The foundation of modern banking was born. By the 17th century, this trick had gone mainstream. In 1694, the Bank of England was created, not for the people, but to finance the crown's wars. It lent far more than it actually held in gold, earning interest on imaginary money. And who paid for it? The public, through taxes. Governments had discovered the same secret. They could borrow money that didn't exist, spend it now, and make future generations pay it back. Across the ocean, early American banks repeated the same game. They printed notes backed by gold, until people realized there wasn't enough gold to redeem them. Panic followed, banks failed, and millions lost everything. But instead of ending the illusion, governments reinforced it by creating central banks. Institutions built to guarantee public confidence, not actual solvency. The message was clear. Even if the money isn't real, the belief must be. Fast forward to today. You deposit $100 in your bank and assume it's sitting there, safe and waiting. In reality, the bank keeps only a fraction, maybe 10%. The rest is loaned out, spent, redeposited, and loaned again. Your $100 multiplies into nearly $1,000 circulating in the economy, but only the first $10 exists as cash. The rest is debt. And since 2020, U.S. banks have had no reserve requirement at all. They don't need to keep even a single dollar in the vault. They can create new money, literally out of nothing, with a few keystrokes. The game is now governed by global rules called the Basel Accords, written in Basel, Switzerland, at the Bank for International Settlements, the central bank of central banks. These laws require banks to hold a tiny amount of real capital against risky loans. But here's the twist. Banks don't lend money from deposits anymore. They create loans first, and those loans become deposits later. When you take out a mortgage, the bank doesn't move cash from a vault. It types new numbers into your account. That money exists only because you agreed to owe it back. Over 90% of the world's money today is not cash. It's digital debt, created by banks out of thin air. The consequences are everywhere. Inflation, because every new loan multiplies the money supply, eroding the value of every dollar. Endless debt, because money itself is born as debt, and interest ensures there's always more owed than exists. Concentrated power, because banks earn interest on money they never had, while governments borrow imaginary funds to finance wars, bailouts, and political promises. The rich grow richer as inflation inflates asset prices, while the working class runs faster just to stay in place. When the illusion breaks, the system crashes. In 1929, over-leveraged banks fueled the Great Depression. In 2008, it was mortgage-backed debt, another house of cards. Each time governments printed trillions to patch the illusion, because without it, the entire economy would collapse. The truth is, this system cannot survive without perpetual belief and perpetual debt. Wherever you live, your country's money supply isn't backed by gold, labor, or production, but by confidence. The strings of the global financial machine are pulled not from vaults, but from boardrooms in Basel. And the truth is chilling. The system needs you to stay in debt. If everyone paid off their loans tomorrow, the money supply would vanish. Overnight. The machine would stop. You are both the fuel and the collateral. The lesson is simple. Money is not wealth. Real wealth is land, knowledge, skills, and freedom. Debt doesn't serve you. It sustains the system. Inflation isn't a mistake. It's the plan. Every year you work harder to chase numbers that buy you less. The only escape is to redefine value, to build something the system can't print. Because when belief fades, the illusion collapses. History doesn't repeat, but it rhymes. From medieval goldsmiths to the crashes of 1929 and 2008, the story is always the same. Too many promises, and a public willing to believe them. This story isn't over, because the system survives only as long as you believe in it. And when that belief dies, so does the illusion of money. If this gave you a new perspective, hit like, comment, and subscribe. History hides the truth, and I'll help you uncover it.